Welcome to Business FM. We're broadcasting from my radio studio at FMR 101.3 FM at the Artscape Theatre at the Foreshore in Cape Town, which is the cultural centre of the Southern Hemisphere. Looking back at the week that's almost concluded, with me is Wilhelm Hertzog from RECM and also debutant Kyle Cox from Morningstar. So, of course, to make him feel really comfortable, I'm going to ask the first question of Kyle Cox. It's been a week where the Rand, I think, Kyle, has been the one that everyone's talking about now. And these rockstar fund managers who have been externalising and internationalising their earnings are suddenly starting to be called into question. But no one's saying anything.
Well, indeed, there is a global search for yield. So emerging markets have come back onto the table in terms of the risk on trade. Obviously, with the low bond yields in developed markets, there is this, hunt for yield, looking for better returns than you would see in, large amounts of negative or low yielding developed market debt. So that risk on trade is back on the table with lower interest rates. If you look at the yield differential in South Africa, compared to developed market bonds, you're getting 8.5% yield on a 10-year government bond here compared to near zero in the developed world. So that's really stimulating capital inflows into our economy, and so buoying the Rand as a result. And then that obviously has effects on the local stock market, as you might know. Many large Rand hedge shares get a lot of their earnings offshore, so this has knock-on effects for their earnings and their stock prices as a result.
And they do, and I think one of the things, Wilhelm, that somebody said to me this week was that certain stocks have been hit, obviously because of the appreciation of the Rand against the, for example, the British pound. Others haven't yet been hit as hard as they should be. I mean, you look at Brait. Wasn't Brait 170 Rand a share at one stage, and it's now below 120 or whatever? It's a massive fall, and people won't say anything against the people behind Brait because they are these superstars. But I mean, they can get it wrong.
No, sure, absolutely. But I think that bet on an ever-weakening Rand has been pervasive throughout markets, throughout the economy. If you talk to businessmen over the past year, everyone wanted to do acquisitions offshore. Everyone was concerned about the political situation in the country. And that consensus trade is often the trade that's most dangerous. And I think that's being proven to be the case this year so far, where if people pile in one direction, if the absolute consensus view is to go in one direction, you can bet your bottom dollar if you bottom Rand, maybe that'll be a crowded trade and prices will be pushed too far in one direction and they'll pull back at some stage.
It's really, really crowded, isn't it? I mean, if we go back to, I think it was December the 5th or the 6th of last year, I can remember I was sitting at a restaurant in Kalk Bay called Kalkies having fish and chips, and I got a text message from a stockbroker saying, "Have you seen what's happened?" I said, "No." And when I couldn't eat my fish and chips afterwards. I mean, and the Rand went to the next morning in yen terms. They converted it to 17.91 against the US dollar. Look at us now. I mean, okay, it's 13.50 right now, but it was 13.15 to 13.20 yesterday. The Rand goes in one direction and it carries on, and that's why I think that this current strength has more legs. Do you agree, or are you a pessimist like Wilhelm is? Because I can see him nodding away or shaking his head in the background there.
Well, it's very hard to say because, in the last 2 weeks, some numbers have come out with the current account. So those, the deficit is falling, which is a positive for the Rand. But if we look at last year's events, I think it just highlights, the volatility of emerging market currencies. So with these events, the political environment's quite unstable at the moment, so it can swing quite drastically overnight, as we saw on December 5th. And if we look at the levels now, they're back at October last year levels. So I think it's very important to have a frame of reference when you are, trying to figure out where it's going to go. It's only been 6 months of sort of Rand strength, but it's important to understand where it's come from. So, as I said, yes, back at October 2015 levels. So it's important to frame it in that respect.
1791, which was the recorded low, was too low for the Rand. Obviously, is 1320 this week's high, 1315 to 1320. Is that too high for the Rand?
Oh, we don't think so. I think if you look on a purchasing power parity basis, which is the way we look at currencies by and large, the rand, fair value for the rand is probably in the sort of 1150 type of range, say, with obviously
the McDonald index or whatever measure you use, the PPP.
McDonald index a bit suspect. I think the robustness of that index as a true measure of value. But if you look at more reliable data and longer term time series, on purchasing power parity basis, 1150 thereabouts, within a range around that is probably sort of the number. So we think at 1330 the rand is actually still too weak despite the stellar run it's had this year. Really? And keep in mind, as Kyle pointed out earlier, there is this massive search for yield. The rand is a very attractive currency from a yield point of view, and what one often finds is that high yielding currencies become expensive on a purchasing power parity basis because everyone is searching for the yield. We're in a fortunate situation that the rand is actually cheap on a purchasing power parity basis, plus it's yielding very attractive interest rates in local currency. So you get that sort of combination, which historically, statistically, there are obviously going to be exceptions, but historically that's been a very powerful combination in favor of a currency continuing its strengthening.
And we've got this situation, Kyle, where we've got the oil price, which it's been volatile this week, but at one stage it was down to a 20% fall from its highs, which was 52, 53, down to whatever it was, 41.5 in Brent crude terms. So in essence, and technically it was in a bear market, and you look at that and the strength of the rand and you say to yourself, well, there's absolutely no justification for interest rates in this country to go up anymore. The rand is strong, oil prices coming down, we've got to cut rates because this country needs some sort of fillip for the economy, which is grinding along really badly.
I would agree based on current levels of the rand, but however we do need to factor in that the MPC itself is not adjusted its expectations of the rand in its own models, so it's still sticking with 1550 in its own model. So it's
do you think they're too conservative?
I would think, based on the volatility that we've seen in the rand, and the slide in the rand that we've seen over the last 5 years, even longer than that, I don't think it's too conservative. I think currencies are inherently difficult to call. I think they work themselves out over the long term. But yes, over the short term, the moves can be quite drastic, and I think it's important for investors to understand and stay the course in that respect, in terms of the businesses they choose. So currencies are an important driver in the short term, but they tend to work themselves out over the long term, as history would show.
You're nodding away there, Wilhelm.
Sure, yes. I think in the long term, interest rate differentials, inflation differentials, fluctuations around purchasing power parity, you end up these things end up working themselves out, and investors get a fair return for the risk they're taking in investing in an emerging market currency, or the lower risk they're taking for buying a developed market currency. So yeah, these things do work themselves out over the long run.
And just to add to that, I think what helps the rand and why we're seeing when emerging markets come back onto the table is the rand is one of the more liquid emerging market currencies. So it's more tradable. So investors, out of the emerging market basket, they would choose the rand, and then obviously the yield differential is contributing.
So if there's an emerging market problem and it's 6 o'clock in the morning because of something that's happened in the Far East, those emerging market traders, those smart-suited young yuppies in London or wherever it is, press that sell or buy button on the South African rand as a proxy for emerging markets. That's what you're saying, really.
I'm saying that perhaps it can be more volatile because it is one of the more liquidly traded, so there can be upsides and downsides to that. Yes, correct.
Would you agree with that, Wilhelm?
Sure, yes. It has historically been a proxy for emerging markets and a favourite of speculators, yes.
Yes, indeed, and fantastic. I mean, I've always said that the rand is like a junkyard dog in a Coen Brothers film or something like that. The dog sitting there all day. It's sitting there and it's asleep and it's got one eye open and a fly comes around and it buzzes and the dog does, you know what it does. It sort of twitches a little bit and does absolutely nothing, and then suddenly it takes off because it sees a cat or something or someone avoids, and it just goes and goes and goes and goes, and then it gets yanked back by its chain, but it goes and goes and goes and goes so fast and for so long and for longer than you think it would, and then. And I think that's what it's doing at the moment, from 18 to 13, I think. So 11.50.
Absolutely.
Okay. And, of course, this impacts JSE-listed companies like Old Mutual, who came out with their results, which came out with its results earlier this week. What a complicated business that is. Are you able to comment on this, Kyle? I mean, Old Mutual, with all its different facets, with all its different currency exposures, with all its corporate activity that's going to go on apparently until the end of 2018.
Yes, of course. I think the business is entering into a complicated phase where it looks to achieve this process of managed separation of the 4 units. But
that's what they call it, managed separation. That's a nice one. The PR company must have got paid an absolute fortune to come up with that instead of split up or something. Managed separation. That's nice. It's like Gwyneth Paltrow and Chris Thingamabob. She said that her divorce was a managed separation. Carry on. Sorry.
Yeah. So the real question with Old Mutual, and it's one of the stocks that's widely held across South African fund managers, is the sum of the parts. Is that going to be worth more than the totality of the business? So many managers do think this way. So the unbundling of the businesses is going to bring a bit of simplification and more focus to those different business areas. But in terms of their results, that was negatively affected year on year by the rand's weakness. I think the figure quoted was 22% average more weakness than 2015 financial year. So that negatively impacted results, and as a result, the share moved on the day of the earnings results.
Wilhelm has glazed over when it comes to Old Mutual because the financial services obviously not at the top of your list at the moment.
Well, I wouldn't say so. We are quite invested in banks in South Africa, so we do hold substantial financial services interests. But I must add, no insurers currently, although we have in the past owned substantial holdings in many insurers, including Old Mutual.
Yes.
When it was going through its crisis in 08 or 09, it was one of our top holdings.
It was below R5 a share, actually, at one stage.
Look, I mean, we started buying at 8, went to 450, which is never a pleasant experience, but then re-rated nicely, and our clients did well out of that. But currently, we don't hold any insurers. Although the sector is becoming more interesting. If you look at the discounts to embedded value that some of these counters are trading at, it's starting to look interesting, sort of 20% discounts to embedded value for the likes of a Liberty or a MMI. So that type of thing gets our attention. It's not as if we oblivious to the sector, I must say.
I speak to somebody every Thursday on this show, and if I mention insurers, he bristles. You almost hear him on the end of the phone. He says they're a proxy for the market. I mean, if the all share goes up 2%, then this particular stock will go up 2% as well. Is that an unfair? Sorry, staying with you, Wilhelm. Is that an unfair assessment of this particular sector of the JSE?
It's not entirely unfair, but I do think you have to assess the businesses on a individual basis. So a business like Discovery is an insurer, but its strategy and its success has been vastly different to many others in the sector. So whereas the stodgier names in the sector definitely are, by and large, somewhat geared plays on the market.
Yeah.
I think there is room for different companies to follow different strategies and to add tremendous value if they follow the right strategy. So yes, to some extent, but somewhat unjustified in other contexts.
On that unjustified note, we're going to take a break. After the break, Business FM will continue. Welcome back to Business FM. Looking back at the week that's almost concluded is Wilhelm Hertzog from RECM and also Kyle Cox from Morningstar, who's a debutant. We've been talking about the Rand. We've been talking about companies like Old Mutual who have an extraordinary exposure to currency movements. Let's talk about something else now, and that is the property sector of the JSE Securities Exchange. I mean, it's almost like every day I have some company that is listing on the JSE because it's got a shopping centre in Poland or something. I'm not being nasty about Poland or shopping centres, but it just seems to be a little bit overplayed, Wilhelm.
Absolutely. I think it's fascinating what's been going on. If you look at what's been listing in the property sector, I mean, a counter like Hammerson, which is one of the largest UK REITs.
It's a FTSE 100 company.
Correct. It takes a secondary listing on the JSE of all markets in the world. Why the JSE?
Thank you.
It's because there's a captive pool of capital chasing yield in foreign currency. That's why. It's as simple as that. I mean, it's because there's a pool of investors here willing to pay substantial premiums for assets which are already fairly expensive in our view.
And Kyle, they probably conceived this idea 18 months ago when the rand, or a year ago when the rand was really starting to look really vulnerable, and suddenly when they come to the market, the Hammerson people and the other people, the 2 or 3 that I can't even mention now because I don't want to be vindictive, and suddenly the rand is at 13.30 rather than 16.30, and they're not feeling silly, but there's, I suppose people will say, well, the rand's going to go back to 16.30, 17, and so it's a viable asset class.
Yeah, it's a very, very difficult one to see because these things obviously have a lot of planning behind them. So views on the currency, I mean, they can't predict that. So it's obviously been a difficult decision for them. But I think obviously, as Wilhelm mentioned, there's obviously this massive demand in South Africa, and similar to the growth of the offshore unit trusts, there is this massive demand sort of chasing that performance overseas. And so we're seeing lots of flows of money, lots of demand chasing the performance on the back of rand weakness, funnily enough. So, We'll see what happens.
Just out of interest, I'm staying with you. Morningstar obviously analyses and evaluates companies like, for example, RECM. Do you take this sort of thing into account? Do you say, well, you're going with the herd? I mean, you've suddenly increased your property holdings by X amount, and we don't think it's the right thing. Do you ever take that into account? I mean, your own macro view at Morningstar, or don't you have one?
No, of course. So we build our capital market assumptions that feed our asset allocation process. We don't generally like to go with a strategic asset allocation. We have a golden asset allocation rule, and that feeds really our blending system when it comes to funds. Speaking of which, we do adopt a contrarian approach to management. So we obviously are aware that the price you pay for an asset ultimately determines your future return. So we are aware of that, and in general we do like to take a contrarian approach. However, when constructing portfolios of funds, we like to have a blend of styles, just to obviously we don't want to bet the farm on one particular style. So we have to think of our investors first and their outcomes and achieving their outcomes. And to this extent, we might have quite a few different styles within a fund portfolio, if you will.
You're shifting in your seat there a little bit, Wilhelm. No. Property. You don't like it?
No.
Bubble, right?
Difficult to point a bubble, to point bubbles out in advance, but certainly not a cheap asset class, which is enough for us to stay away. I mean, as you say, the listings, the corporate activity in the sector, it's just classic top of the cycle type of conditions that still prevail.
Really is, isn't it? Yeah.
I mean, you have seen some of these counters come off, some of the lower quality ones trading at discounts to NAV these days, as opposed to the premiums to NAV they were maybe priced at shortly after listing. So some of the heat has maybe come out of the market in a small way around the fringes, but the core of the market still very much something which we think is priced for some optimistic future assumptions.
Commodities now. The gold investment demand in the first half of 2016 was a record high for the first half of any year. It's still only at 1340, 1350, but people seem to be not betting the farm on this thing, but there seems to be a momentum in gold, and it's an old style. People will say, well, the gold price. You're a South African, so of course you like gold, and there were these old stale bulls come out of the woodwork every now and again. It just seems a little bit different this time. It's a terrible phrase, a little bit different. But Kyle, gold shares?
I think January sparked off with quite a bang. I think it was one of the worst January months on record, or if not the worst. And investors flocked to safe haven assets such as gold. So this is naturally expected. Supply and demand. We'll have gold price going up as investors look for safe haven assets in gold, whether it be golds or bonds. And it's continued that run, just as a gauge of investor uncertainty, market uncertainty, people maybe losing a little bit of confidence in the monetary system, really, with global monetary stimulus at all-time peaks. That central banks are really running out of the tools that they need to stimulate the economy, so they're really just printing the money, hoping everything's going to be okay. But this causes investors to lose that confidence and look for store value assets, which
I've heard that story so many times over the last 4 to 5 years. It started 2 years. 2 years after the global financial crisis, Wilhelm. I know you don't look at macro that much. You're a different type of investor, but it really is getting long in the tooth now, isn't it? All this money printing.
Sure. Yes. I mean, it is, and I guess the question is, will it eventually turn all developed market currencies into trash, or won't it? And people buying gold is betting that it will. And we're not entirely unsympathetic to that view. I mean, we recognize the fact that the monetary policy experiments going on in the world are unprecedented, may well end up badly. In that scenario, gold may well come through for an investor who's held it. So, but we are a bit cautious of this rush into any given asset class. This typically points to an asset which is not particularly cheaply priced. One is rather looking for the ignored, unloved if you're a value investor. So,
like Transec, for example, that's a share that's been unloved for 4 to 5 years. 370 to 450 or 350 to 450, and suddenly your colleague, Piet Viljoen, and a well-known and fairly wealthy man with influence in South Africa, suddenly had a look at this thing. Are you allowed to comment upon this?
Sure, yes. I think I'm at liberty to comment.
Then do so.
But I mean, nothing really to add to the comments that my colleague Mr. Viljoen have made about the transaction, etc. But Transec is a business in which RECM clients or RECM affiliates have owned shares for better part of 10 years now.
Yes.
Hasn't been an entirely spectacular investment over that 10-year period, it must be said. But it's a management team we trust, and we do think they can do things with the assets under their control currently. So, and it's a management team.
But it's done nothing for 5 years. So, I mean, it's the same management.
Well, they've been running off their flagship mine, and they've been hoarding cash on the balance sheet, and that cash gives them interesting opportunities.
How much cash is there in the share price? I mean, I haven't looked at it for so long. I mean, the share price is what at the moment?
Speaking in roughly numbers, I think it's about a 400 million market cap, and they've got about 300 million rands of net cash on the balance sheet.
So you're getting you're getting everything for nothing, really. What do you say when you see a superstar like Christo Wiese coming into a share like this, Kyle? I mean, obviously, when the name Christo Wiese comes to the fore, you suddenly think, well, there must be something to this, because he doesn't do it for fun.
I would agree with that. Christo Wiese's got a long track record of building businesses up from the start. So, I mean, anyone around seeing Christo Wiese, putting his time and effort and money into a business would be some sort of a signal. But I think the fundamentals have to be there for the business. So there have to be long-term fundamentals, competitive advantage of that business, and a whole host of other metrics that you would look at to assess the long-term viability. So management would just be one factor amongst all of those factors.
Yeah. The oil price, there was a record Saudi production output figure that came out this week, and they called it an OPEC pump fest. The market came down and went close to that sort of bear market territory again, and then it suddenly reversed, and I don't know why it reversed, but the oil price to me is on the slide again. That Saudi story means that they want this thing down.
It does look like it, yes. I mean, one did see, I think, if you look at drill rig numbers in the US, they did start creeping up again when the oil price recovered in the early part of this year. So, yes, it does look like the Saudis think that the end game has not been reached yet, and they want to keep the pressure on for longer until more of the US shale business is out of the game. That's what it looks like, yes, one must say.
It's such an important story for South Africa because it influences all the other commodities, although there has been a little bit of a disconnect in the last 6 months or so. What about the United States of America? I don't know what you were doing on December the 31st, 1999, Kyle. What were you doing then? Were you about 3 years old or something? What?
I think I was probably in grade 7, playing on a cricket field somewhere.
Yeah, but on December the 31st, the NASDAQ, the S&P and the Dow Jones all synchronized to go to all-time record highs. December the 31st, 1999. And last night, the same thing happened. So the headline, of course, in the newspapers and everywhere else was, the markets are partying like it's 1999. So we've gone to record highs. And what is that? I mean, it's just people buying because there's nothing else to buy?
Well, you've got record low yields on bonds. So stocks, people are looking to put their money somewhere. So your dividend yields on stocks, you're getting the dividend yield as well as you're getting the possibility of capital growth. So in terms of chasing that yield, it's not just happening in emerging markets, it's happening within the asset classes. So instead of putting your money into, US bonds, which are yielding very low, you actually go into stocks that are actually becoming almost a fixed income alternative with the dividend yield and the capital growth component.
Do you agree with that?
Absolutely. I think that's definitely the dynamic one sees in markets today. One sees this acronym of TINA. There is no alternative. You must buy stocks, and that's why they go up. Because rates are so low, you can't get any yield anywhere. The dividend yield will grow steadily, and you'll be safe there, which we obviously think is a dangerous assertion to live by.
So if you normalised conditions, you wouldn't be buying these things. It's just because the situation is not normal that you're buying them.
Yes.
So it's the cleanest dirty shirt or something.
Yeah, something along those lines. Absolutely. But yes, I mean, one doesn't know how these things revert to normality and when and what triggers that reversion. But it's reverted well, and there will be plenty of pain when that time comes. And I think one must just be cautious and cognizant of that when buying equities
Plenty of
today.
pain when that time comes. We've been waiting for that pain for ages. Last word from you, debutante Kyle Cox from Morningstar. Do you see pain? Potential pain?
Definitely. I think there's a lot of talk, since the 2008 crisis of sort of kicking the can down the road with monetary stimulus. Eventually, the real economy has to tick along. So at the moment, they're just stimulating the nominal economy, and we're seeing in bond markets somewhat there is talk of a bubble in bond markets. So it's difficult to predict these things and how all these policies will align within the global atmosphere. Markets are, the most interconnected they've ever been.
Yes.
So it's very difficult to predict. But definitely, I do see some change coming down the line.
I think there's got to be a short hedge fund brewing here, property and bonds. Get short of both of them. That's it for Business FM. The show will be back same time next week. Thank you very much to Kyle Cox from Morningstar, and also joining him at the desk this evening has been Wilhelm Hertzog from RECM. The show will be back same time next week.